Hello, everyone. My name is Will Lockwood, and I'm a Paraplanner with the Rice Partnership, working out of the San Luis Obispo office. Today, I'm joined by my colleague, Tyler Sanchez, who is a research analyst on our investment team. We wanted to take a few minutes to discuss two planning strategies you're often asked about: Delaware statutory trusts, or DSTs, and qualified opportunity zone funds. Tyler is going to provide us with a high-level overview of how each strategy works, key differences between them, and the type of client that could benefit from these investment vehicles. So Tyler, let's start with the basics. What are Delaware statutory trusts?
Hey everyone. Yeah, so Delaware Statutory Trusts, or DSTs, allow real estate owners to defer capital gains taxes by using them as a replacement property in a 1031 exchange. Under IRC Section 1031, investors can exchange one like-kind real estate investment for another without immediately recognizing capital gains. These DSTs are fractional ownership vehicles, meaning multiple investors can own interest in large institutional quality real estate, such as apartment buildings, industrial properties, or even something like senior housing. Investors typically receive monthly income, and the sponsor usually plans to hold the property for several years. At sale, investors may choose to complete another 1031 exchange, depending on their situation.
Thanks, Tyler. That's a helpful overview. Let's move on to qualified opportunity zone funds. Can you give us an overview of these investments?
Yeah, so opportunity zones were created under originally the Tax Cuts and Jobs Act of 2017. They were later made permanent by the One Big Beautiful Bill Act of 2025. Governors have designated certain census tracts as opportunity zones to encourage economic development. A qualified opportunity fund pools investors' capital to develop or substantially improve real estate in those designated areas. The key advantage is that capital gains from almost any source, not just real estate, can be invested, including gains from sale of stock or a sale of a business. Unlike a DST, only the gain is reinvested, not the full sale proceeds. So taxes on that gain can be deferred, and if the investment is held for at least 10 years, any appreciation on the opportunity zone investment itself can be sold tax-free. These are long-term illiquid investments, and cash flow is often limited in early years due to the construction and development.
Interesting. Sounds like these two strategies are quite similar, but have some key differences. Could you walk us through who would be an ideal candidate for a DST versus an opportunity zone investment?
Yeah, a DST is better suited for real estate owners who are looking to complete that 1031 exchange, who also want passive ownership, steady income, and that tax deferral by reinvesting both principal and the capital gain. An opportunity zone fund investment would be better for investors with the capital gains from any source outside of real estate, including real estate, who are focused on long-term growth and tax efficiency, but are comfortable with the limited liquidity and the delayed cash flow. In short, I think DSTs favor income and continuity for real estate sellers, while opportunity zone funds favor long-term growth-oriented investors. I just want to thank you all for joining today, and happy holidays to all of you, and we'll see you all in the next year.